when I first started to look at this, I thought, well, why can't I assess your situation like I might assess a company and take it apart? I mean, and I'm not going to take it apart for you, but I wanted to give you some ideas, some things that if you sit down, it's pretty easy, sometimes painful to think about it, but pretty easy to think about what I call the balance sheet, because you really can't plan. I think you can't plan for the future until you assess where you are. And the first step is to take stock. And maybe a lot of you already done that, and I don't really want to be repetitious to it, so I'm going to try and hit upon some of these things. But I mean, it's really very simple. It says, what do I own? I mean, if you had to sit down here day one today, how do I put a value on what I own? And that really comes down anywhere from liquid to illiquid assets. And what I mean by that is, obviously, you need cash, you need savings accounts. If you have them, that's your liquid reserve along the way. Money market funds, CDs, they're there. Everybody should have money set aside, which I call the rainy day money that may not be earning the type of return you need, but it's your liquidity base, that's your emergency kit, if you will, that allows you to do that. So if you take a look at that, you have that. Brokerage accounts. You may have a brokerage account. That's part of the assets that should be put together on a page. That's all on the what do I own side. Annuities. I don't especially like fixed rate annuities, especially with rates where they are at the moment, because the fees are pretty high and the payouts are pretty low. At some point in time, you go back historically, you had a pretty good return. Actually still hated the fees associated with annuities, but sometimes it was a help to have the annuity because it actually did kick out enough cash income. The problem with it is now is the insurance companies, they take their piece, and I'm not criticizing anybody who's in the insurance business, and annuities still could play a role. It's just that there's a pretty good expense factor relative to what the income factor that's coming out of current annuities. And as we're moving down the illiquid side, real estate. I made those comments earlier about our clients and some of the older clients that are retired. They also get hit with a double whammy of having the worst real estate market in the last 20 some years. The idea that real estate always went up, that's been in value, is obviously that always word has now disappeared from the genre, if you're a genre, I would say. And you're sitting in a situation where, fortunately, the older moving towards retirement people have equity in their houses. That's usually a plus. So at least there's a cushion that's still sitting there. It's not the same cushion it was 3 years ago, which is a cause for worry. But if that cushion's there, I always use that as the ultimate emergency cushion, because there are things like reverse mortgages that some people really legitimately do, where if you ever had to turn your house into a piggy bank for the right reasons, as opposed to the real estate crisis we have, where people turn their house into a piggy bank by borrowing the money, perhaps putting it in another house, perhaps buying a boat, perhaps buying 2 new cars, perhaps going to Europe, whatever, but they're saddled with essentially 2 mortgages now, the one that they are continuing to pay on and the other that's choking them. Cash value on life insurance. A lot of people forget to think about that because they're always thinking about the payout associated with the life insurance. But there's always, if you do have cash value life insurance, there's an ability to tap those at very attractive rates, very attractive rates, certainly better than what you'd get from a brokerage loan, and they're there to be used. And they always send, insurance companies don't like to have you tapping cash value, because they'll come back and they'll always warn you every 3 months or 4 months that you're paying interest on it, but you're paying less interest than you might be paying somewhere else if you needed the money and if you're borrowing from it. So you just say, okay, that's fine. Thank you very much for charging me the interest, but I need the money. Pensions, disabilities, 401ks, IRAs, all of those coming together. In fact, I left IRA off, but I mean, those are all assets that you're looking at. You're trying to arrive at investment policies for those assets. How do I position those assets But at least on the asset side of what do I own, I'm going down that page. Excuse me, I thought I shut all that off. Well, it's very unusual for me. I did show you I said I didn't quite know how to shut it. It never gets shut off, so I have trouble finding out how to do it. I think I usually silence it, but I don't think anyone else is going to try and find me from there. But I started to say is that even within those vehicles, the IRAs and 401k plans and those savings type plans that you may have had at work, I mean, there's still judgments that have to be made about how to position those assets and how do you want to invest those assets. And then there's the illiquid piece. You know, if you really take it down, and I told my wife, and I was kind of thinking about this with her, is that, you know, you kind of run through all those assets and you total them up. I mean, doesn't mean you're going to tap them, doesn't mean that you're going to have to use them, but at least you know, to the best of your knowledge, what do I have at this particular date as I'm trying to take this apart? What am I working with? What's the total asset base? What's liquid? What can I get to as an emergency? What can I get to without a lot of what you'd call with a lot more stress? And then on the other side is the O side, and there's always somebody got an O side. I mean, you know, if your choice is if you have enough money in a money market fund or a savings account that's more than your excess reserves, I'd probably tell you to try and pay off your credit card debt if you have credit card debt, because you think if you have excess short-term money sitting there, what you're earning on it is far less than what you're getting taken away from in terms of your credit card debt. And not everybody can erase credit card debt, and I'm not stepping into everybody's situation, but credit card debt is extremely expensive. The mortgage, obviously, on what you owe on that side, car loans, loans in general. I mean, that's essentially the O side of the side, and the difference is what I'm really worth. You know, if you really take your time and work your way through the what do I own side and break them down into kind of liquid, illiquid, what can be tapped, what can't be tapped, you're really sitting in a situation where you come up with that financial term net worth. And the net worth is the difference really between what I own, if you will, and what I owe. And it's that piece that you're going to take a look at to see what it can generate from what I call the income statement. And that falls before, you know, you have the asset base over here, you know what your net worth is, and then it's a question of saying, okay, am I still employed? Do I have wages? Do I have pensions? Am I collecting disability? There's any of these funds coming through that are creating a monthly cash flow, because that cash flow is going to be augmented by what you can do with the assets from the what do I own side of the equation. And you know, the difficult part is that, you know, you actually have to sit down to be able to do this. I was thinking about this myself, and we have some planning tools that do that, but, you know, being able to sit there and say, okay, you know, what is my monthly budget? What do I have to spend to do this? What are the costs? And how much of that is covered from the net worth or income flow, plus wages, plus disability, plus all the things you can talk about? Or maybe it isn't covered, which says then you got to really dig in to say, how long are the assets that I have are going to last? I mean, that's a function. If you got the deficit and you have the net worth over here, and you can't correct what the spending pattern is, if you will, for what your expenses are, then you're sitting in a situation where how do I then look at the assets that I have and arrive at the best possible methodology, if you will, of preserving and still growing those assets. And I'm going to say right now that there's varying degrees of sophistication when it comes down to looking at your investment skills and what you're going to do with your investments. But you know, if you have those assets put aside, the short-term reserve, and then you have the other group of assets that you can invest. You know, people are afraid of the stock market. People are afraid of, you know, the world's coming to end on TV every other day. The news comes out not being good. But you really have to arrive at some kind of balance between what I call investing for the future versus assessing the amount of risk you could take today relative to your assets, because sitting in the CD, sitting in the money market, it doesn't meet your income needs, and it also won't be able to protect your purchasing power. And what you're really trying to do is, with that net worth side, is be able to grow those assets that you have and grow them in a sense that they're growing at a rate that's higher than inflation's going to take it away. And I know I'm talking about situations that don't necessarily apply to everybody, but in the ideal world, you'd have that short-term cash reserve as you did your balance sheet look. You had your income statement that said, I have my net worth, I can cover my net assets or my net expense flow out of my income, and I have an asset pool to invest. And then it comes down to saying, how much risk can I take associated with the asset pool?